You must understand something fundamental about trading. The market doesn't move because of charts, indicators, or even your analysis. It moves because of behavior, the collective actions of thousands of traders expressing belief, fear, confidence, and uncertainty. And if you learn to see those subtle shifts before everyone else does, you stop losing money, not because you've become a fortune teller, but because you've learned to spot the psychological tipping points that drive price. One of the most powerful, yet most overlooked, clues is hidden in volume. Price may display what happened, but volume reveals the intention behind it. When volume expands in a very specific way, it signals that the balance of belief in the market has changed. Not might change, but has already shifted. And once that shift occurs, a major price move becomes not a guess, but a high probability scenario. The traders who consistently win aren't the ones who know more. They're the ones who recognize when the crowd is quietly repositioning before the explosion. Markets tip their hand every single day, but most traders can't see it because they're focused on predicting outcomes instead of reading the underlying behavior. Today, you'll learn the secret volume signal that exposes this shift before price reacts, not to give you certainty, because certainty doesn't exist, but to give you confidence, confidence built on understanding, not hope, confidence rooted in probabilities, not emotion. If you're tired of losing money, tired of being late, and tired of wondering why the market seems to move against you, then this is your turning point, because once you recognize this signal, you'll never look at a chart the same way again. The market is a reflection of collective beliefs, not logic, and volume exposes those beliefs before price does. Traders often approach the market believing that logic, analysis, or intelligence will give them an edge, but the truth is this: the market doesn't reward logic. It rewards awareness. It rewards perception. It rewards the trader who understands that price is nothing more than the final expression of millions of individual decisions, all converging into a constantly shifting consensus. And that consensus, that mass psychological agreement, is always visible in volume before it becomes obvious in price. Think about what a chart really is. Every candlestick, every tick, every bar is just a snapshot of where the collective belief landed for that moment. Price moves not because it should, not because it's due, not because a pattern says so, but because enough people believe something long enough to create a new reference point. When belief shifts, price shifts. But belief doesn't shift silently. It leaves traces. The first and most reliable trace is volume. Volume is participation. Participation is commitment. Commitment is belief. When traders start stepping in more aggressively, when institutions start quietly accumulating or distributing, when the crowd becomes more confident or more fearful, the very first place you can see it is in the number of transactions occurring. Price can still appear calm while volume reveals turbulence beneath the surface, like ripples under still water. Before a major breakout, before a reversal, before a collapse, the beliefs of market participants begin to reorganize, and volume exposes that reorganization before price has any obligation to reveal it. Most traders lose money not because they lack intelligence, but because they misunderstand what the market truly represents. They see price as cause and volume as effect. In reality, volume is cause and price is effect. Volume is the vote. Price is the election result. And if you want to stop losing money, you need to stop looking at the outcome and start paying attention to the voting process that leads to it. The challenge is that most traders want certainty. They want the market to be logical, methodical, predictable. They want every action to have a clear reason. But the market isn't built on logic, it's built on perception. Perception shaped by fear, greed, urgency, hesitation, and the constant need for validation. When enough people perceive the same thing at the same time, even if it's irrational, price will move in that direction. The market doesn't care about truth. It cares about agreement. It cares about collective conviction. And volume is the purest measurement of that conviction. This is why price can look stable right before a massive move. The beliefs underneath are already shifting, but the crowd hasn't yet expressed those beliefs through price. Institutions accumulate quietly, adding positions in small chunks so as not to disturb price. Experienced traders begin positioning based on fundamental or sentiment-driven insights. Volume begins to expand in subtle ways, Not explosive, not dramatic, but enough to show that the underlying consensus is no longer the same. Then, only once this hidden restructuring is complete, price finally reacts. To the trader paying attention to volume, that move is expected. To the trader watching only price, that move appears sudden, unpredictable, unfair. When you accept that the market is a psychological environment, not a logical one, everything changes. You stop trying to predict outcomes and start reading behavior. You stop fighting the crowd and start understanding it. You stop demanding certainty and begin working with probabilities. And probabilities are what volume reveals more clearly than anything else. Every surge in volume tells a story. Sometimes it's a story of fear, a rapid rush for the exits as traders abandon their positions. Sometimes it's greed, aggressive buying fueled by the belief that a big move is coming. Other times it's the story of professional accumulation, slow, steady increases in volume that barely move price, revealing that someone with deeper pockets is preparing for a significant shift long before retail traders notice. Price alone won't tell you that story. Price will hide it. But volume exposes it in raw, unfiltered form. Think of volume as the heartbeat of the market. You can't rely on price without listening to the heartbeat. A chart with no volume context is like a body with no pulse information. You might see the shape, but you have no idea about the pressure building beneath the surface. The heartbeat tells you whether the body is calm, stressed, accelerating, or collapsing. The heartbeat reveals when something is about to change, even before the physical movement begins. Traders who ignore volume are trading blind to the most essential signal that precedes every major price event. Understanding this changes how you interpret the market. Instead of reacting to price moves after they've happened, you begin anticipating them by observing how beliefs are shifting in real time. When you see volume rising while price consolidates, you know that pressure is building. When volume fades while price climbs, you know that conviction is weakening. When a sudden burst of volume breaks through a stubborn support or resistance level, you understand that the collective belief has reached a tipping point. These are not predictions, these are observations, objective, measurable, repeatable. Consistency in trading comes from aligning with the market's underlying psychology, not from forcing logic onto it. Volume is the bridge between the psychology and the chart. It shows you when traders agree. It shows you when they disagree. It shows you when something is changing. And the trader who can see these changes early has a significant advantage because they are no longer reacting emotionally to price. They are responding rationally to shifts in belief. One of the most damaging habits traders have is assuming that price must move simply because they expect it to. They confuse analysis with insight. They confuse confirmation with certainty. But the market doesn't respond to your expectations, it responds to the collective's expectations. And the only objective way to measure the collective's expectations is through volume. If you truly want to evolve as a trader, you must let go of the need for the market to make sense and start accepting the nature of the market as it truly is. It's a dynamic, ever-changing environment shaped by human behavior. People hesitate, people overreact, people panic, people become overly confident, and all of this shows up in volume long before it becomes visible in price. When you internalize this, you stop losing money not because you've mastered prediction, but because you've mastered recognition. You begin to recognize when beliefs are shifting. You begin to recognize when the crowd is preparing to act. You begin to recognize when a major move is forming beneath the surface. And suddenly, the market stops feeling chaotic and starts feeling understandable. The market is a reflection of collective beliefs, not logic, and volume exposes those beliefs before price does. If you want to stop losing money, if you want to trade with clarity instead of confusion, and if you want to operate in alignment with the real forces driving price, then learn to read volume, not as an indicator, not as an afterthought, but as the primary language of market psychology. Because once you understand that language, you'll see the market with a level of confidence and calm that most traders never reach. Consistency in trading comes from understanding probabilities, and volume surges are one of the rare objective clues that shift those probabilities in your favor. Most traders begin their journey believing that consistency is about being right, about predicting the market, finding the perfect setup, or discovering some secret pattern that guarantees profits. But the reality is far different. Consistency has nothing to do with being right and everything to do with working within a framework of probabilities. that you genuinely understand and trust. The market is uncertain by nature, chaotic by design, and unpredictable in its specifics. Yet within that uncertainty lies a structure, patterns of behavior, emotional responses, and shifts in belief. Volume is one of the few tools that reveals those shifts in real time, giving you an objective anchor in an environment dominated by subjectivity. To understand why volume is so powerful, you must first understand what probabilities mean in trading. Every trade you take is a risk, not because the market is against you, but because the outcome is inherently unknown. You can never know exactly what will happen next, but you can identify conditions where one outcome is more likely than another. Consistency comes from recognizing these conditions and treating each trade as part of a larger series where the edge plays out over time. It's not a single trade that defines your success, but the accumulation of many trades made within a probabilistic framework. But most traders struggle to embrace probabilities because they want certainty. They want a signal that guarantees a big move, an indicator that eliminates doubt, or a pattern that never fails. That desire for certainty leads to emotional trading, overconfidence, and poor risk management. When a trade goes wrong, they take it personally, as if the market made a mistake or betrayed them. They forget that every trade is simply one occurrence in a vast series of occurrences, and because they can't see the market probabilistically, they can't act consistently. Volume surges help break that emotional cycle because volume is an objective measurement of participation. Unlike price, which is influenced by countless factors and can be manipulated or distorted, volume reflects real action, real buying, real selling, real commitment. When volume surges, it signals that something has changed in the behavior of market participants. It tells you that more traders are stepping in with conviction, that demand or supply is intensifying, and that the probabilities of a significant shift have increased. Volume doesn't tell you exactly what will happen, nothing does, but it provides one of the clearest indications that the underlying dynamics of the market are changing. It shifts the probabilities in your favor because it gives you evidence that the crowd is committing to a direction, and when the crowd commits, momentum follows. Think about a quiet market, where price drifts sideways and volume remains low. In those conditions, the market is indecisive. Neither buyers nor sellers are willing to take control. Every trade you take in that environment has lower probability because the market lacks conviction. It's like entering a race where no one has started running yet. There's no momentum to carry your trade forward. But when volume suddenly surges, the environment changes instantly. It's the equivalent of a burst of energy, a sudden alignment of belief among participants. More traders enter the market, pushing price with greater force. When that surge occurs in a strategic location, near support, resistance, breakout zones, or after a period of compression, the probabilities shift dramatically. Not because the pattern changed, but because the underlying behavior changed. This shift in behavior is what most traders never learn to recognize. They focus on what price looks like, rather than what traders are doing behind the scenes. They search for the perfect line, the perfect indicator, the perfect curve. But none of that matters if volume doesn't confirm conviction, because a breakout without volume is just a hope. A reversal without volume is just a theory, and a trend without volume is a trend waiting to die. Volume surges are rare because they only occur when strong belief enters the market. Most of the time, price moves quietly, drifting as small traders make small decisions. But when institutions, professionals, and experienced participants enter with size, they leave a footprint, a spike in volume that cannot be hidden. That footprint is your signal that the probabilities have shifted. It's evidence that something meaningful is happening, something that alters the balance between buyers and sellers. Understanding this transforms the way you trade. Instead of guessing, you observe. Instead of predicting, you respond. Instead of acting on emotion, you act on evidence. And as a result, you become consistent, not because you win every trade, but because you understand why your edge works and how to apply it repeatedly. Consistency is not created in moments of clarity. It is created in the ability to operate in moments of uncertainty. Volume is what gives you the confidence to operate despite uncertainty. It doesn't eliminate risk, but it provides a statistical advantage. When you see a surge in volume, you know that the probability of follow-through has increased. You know that the market has transitioned from indecision to commitment. You know that the crowd has taken a stance, and the market is more likely to move strongly in response. Most traders treat volume as an afterthought. They glance at it, but they don't understand it. They see spikes, but don't interpret them correctly. They look at volume like a secondary indicator rather than the backbone of market psychology. But once you understand volume, everything changes. You start noticing patterns that price alone never reveals. You start detecting accumulation, distribution, hidden buying, hidden selling, quiet positioning before major announcements, and emotional spikes during panic or euphoria. These patterns are all probabilistic clues, and they are all rooted in volume. When you see a breakout with strong volume, you're not hoping for confirmation. The confirmation is already there. When you see a reversal backed by a massive surge in volume, you're not guessing whether the market is changing direction. The shift in belief is already visible. When you see consolidation with rising volume, you're not uncertain about what's coming. You're preparing for the inevitable expansion. This is why volume surges shift probabilities. They remove ambiguity. They reveal commitment. They show you where the market is likely to go, not because of technical patterns, but because of human behavior. When belief becomes strong enough, it manifests in volume. And when volume aligns with structure, the odds tilt heavily in your favor. Consistency in trading comes from aligning yourself with those odds over and over again. It comes from seeing the market as a series of opportunities, not challenges. It comes from embracing uncertainty rather than fighting it. And volume surges are one of the most reliable signs that the uncertainty has been reduced, that the crowd has spoken, and that the momentum has begun. When you trade with this mindset, you stop caring about being right. You stop chasing trades that lack conviction. You stop forcing outcomes that have no statistical backing. Instead, you start waiting for the moments when volume shows you that the probabilities have shifted, and when they have, you act decisively and without hesitation. This is what creates consistency. A deep understanding of probabilities combined with the ability to recognize one of the most powerful signals the market offers. Volume is not just another indicator. It's a window into the beliefs, fears, and intentions of every trader in the market. And volume surges are the moments when those beliefs converge into action. When you learn to trust that, when you stop fighting the randomness and start working with the behavior, consistency becomes not just possible, but natural. The market stops feeling chaotic and starts feeling structured. And you stop losing money not because you've eliminated risk, but because you finally understand where the real probabilities lie. Your job isn't to predict the future, but to recognize high-value opportunities. This single shift in perspective is one of the most transformative a trader can make because it moves you out of the impossible task of forecasting and into the achievable task of identifying favorable conditions. Most traders sabotage themselves by acting as if their role is to know what comes next, to declare confidently where the market will go, and to feel a sense of certainty before taking action. But the market doesn't reward certainty, it rewards adaptability. It rewards awareness. It rewards the trader who understands that the future is unknowable, but the present is full of signals that reveal the probability of meaningful opportunity. The desire to predict comes from fear, the fear of being wrong, the fear of losing, the fear of uncertainty. The human mind hates uncertainty, and the market is nothing but uncertainty. So traders cling to analysis as if it can remove that uncertainty. They pile on indicators, draw lines everywhere, memorize patterns, and try to engineer a level of precision that simply does not exist. Every losing trade feels like a personal failure instead of what it truly is, a natural outcome of a probabilistic environment. When you believe your job is to predict, every loss damages your identity, not just your account. Every unexpected price movement feels like betrayal. Every deviation from your expectation feels chaotic. And from that emotional place, consistency becomes impossible. You begin to hesitate on good trades and jump impulsively into bad ones. You start forcing trades that fit your prediction instead of waiting for opportunities that fit your edge. You try to make the market comply with your view instead of responding to what the market is actually offering. But when you understand your job is not prediction, but identification of high-value opportunities, everything changes. You start seeing trades the same way a casino sees gamblers. Each single outcome is irrelevant, but the long-term probabilities matter. Your job becomes one of selection, not prophecy. You are no longer trying to guess the future, you are observing the present objectively. And in the present, opportunities are always forming, always shifting, always emerging. The market is a living environment, constantly evolving. Your task is simply to recognize when the environment is favorable. What is a high-value opportunity? It's a moment when multiple factors align to create a scenario where the probability of a significant move is higher than normal. It's where structure, behavior, and volume combine to signal that something is about to change. It's not a guarantee, nothing is. But it is a moment where the risk is justified, the reward is meaningful, and the conditions support action. Recognizing these moments requires clarity. It requires emotional neutrality. It requires the ability to see what is actually happening, not what you want to happen. And it requires you to detach from outcome, because outcomes are outside your control. You cannot control whether a trade wins or loses. You can only control whether the trade meets your criteria for a high-value opportunity. When traders shift into this mindset, they stop expecting perfection. They stop demanding certainty. They stop feeling wounded by losses. Instead, they begin evaluating each potential trade the way an expert evaluates odds. They ask, does this setup align with my edge? Does the environment support movement? Is the volume confirming conviction? Is the structure clean? Is the risk acceptable for the potential reward? If the answer is yes, they take the trade calmly. If the answer is no, they walk away without hesitation. The irony is that when you stop trying to predict the future, you paradoxically begin to feel more confident, because you are no longer burdened by trying to control the uncontrollable. You are simply responding to conditions. In that response-based approach, the emotional weight disappears. You are not personally responsible for where the market goes. Your only responsibility is evaluating whether the present moment offers a worthwhile opportunity. High-value opportunities appear when traders collectively shift their behavior. You can see this shift in the tightening and expanding of ranges, in the interaction with key support and resistance, in the building of compression, and in sudden surges of volume. These clues are not predictions, they are evidence. Evidence that participants are repositioning. Evidence that pressure is building. Evidence that the balance between buyers and sellers is changing. Imagine standing by a dam holding back a large body of water. The dam looks solid. Nothing appears to be happening, but then you begin to see subtle cracks forming. You hear the vibration of pressure building. You notice water seeping through tiny openings. These are the signs. You don't know exactly when the dam will break. You don't know how forceful the release will be. But you know with very high probability that something significant is about to happen. A high-value opportunity in the market works the same way. You don't need to know the exact timing or the exact price target. You just need to know when the conditions suggest that a meaningful move has become more likely. Your job is not to guess the details, it is to recognize the shift. When you approach trading this way, you stop feeling like you're constantly swimming against the current. You stop fighting with price. You stop demanding that the market validate your ego. Instead, you wait patiently for moments when the current flows in a clear direction, when the water's pressure is obvious, when the cracks in the dam appear. Discipline is not about rigid rules or suppressing emotion. Discipline is the ability to remain aligned with your edge and avoid anything outside of it. It is the ability to recognize that most moments in the market are not worth your time, not worth your risk, not worth your attention. High-value opportunities are rare. That is why they are valuable. And when you learn to wait for those moments, your trading changes from chaotic to deliberate. One of the most destructive habits traders fall into is forcing trades during low-quality conditions. They convince themselves that something is about to happen simply because they are bored, anxious, or eager to make money. But the market does not reward impatience. It rewards patience, because patience keeps you aligned with high-value conditions. The trader who takes 10 low-probability trades loses both capital and mental clarity. The trader who waits and takes one high-value trade keeps capital intact and builds confidence over time. Recognizing high-value opportunities also requires flexibility. Markets change. Volatility expands and contracts. News shifts sentiment. Liquidity conditions fluctuate. In this constantly changing environment, predicting is hopeless, but adapting is powerful. Adaptation means updating your perception with every new piece of information. It means noticing when conditions improve or deteriorate. It means adjusting your expectations based on the reality in front of you, not the one you imagined. This is why obsessing over predictions destroys traders. When you're attached to a prediction, you distort what you see. You ignore evidence that contradicts your view. You cling to a losing trade because you want to be right. You miss better opportunities because you're focused on proving your forecast. But when prediction no longer holds emotional importance, you become free to see the market as it truly is. You become free to follow the highest value opportunities instead of chasing narratives. Great traders are not prophets. They are observers. They are students of behavior. They are masters of probability. They understand that the market's future direction is always uncertain, but its present conditions are always knowable. And within those conditions lies the edge. Your job isn't to predict the future. You can't. No one can. Your job is to identify the moments when the imbalance between risk and reward is in your favor. Your job is to recognize when probability, structure, psychology, and volume align to create a window of opportunity. Your job is to execute your edge without emotional interference and without the illusion of control. When you embrace that, you begin operating as a professional. You stop chasing certainty and start pursuing clarity. You stop reacting emotionally and start responding strategically. You stop trying to control outcomes and start controlling your decisions. In that mindset, consistency becomes possible, not because you eliminate losses, but because you eliminate chaos. Not because you always win, but because you always operate within high probability conditions. And when you do that, the market begins to reward you, not because you found a way to predict the future, but because you finally learned how to recognize the opportunities that were always right in front of you. Consistency comes when you stop trying to predict the future and start recognizing the moments where probability leans in your favor. High-value opportunities aren't born from certainty, but from clarity. Clarity in volume, structure, and behavior. When you learn to wait for those moments, act decisively, and detach from outcome, trading becomes simpler, calmer, and far more profitable. Your edge isn't prediction, it's perception. Recognize the opportunity, manage the risk, and let the market do the rest.